Es ist ein Merkmal dieser Tagung seit 20 Jahren, dass wir kluge Köpfe aus den USA hier erleben dürfen in Frankfurt. Oft Vordenker oder oft auch bekannte Namen, die durch Innovation unsere Branche wirklich nachhaltig verändert haben. Und einer davon ist auch der Malcolm Baker, Professor Malcolm Baker. Er ist Professor an der Harvard Business School und auch Direktor für Corporate Finance des National Bureau of Economic Research. Das sind diejenigen, die diesen US-Rezessionsindikator veröffentlichen. Dafür sind sie sehr oft berühmt. Seine Forschungsgebiete sind Behavioral Finance, Corporate Finance, Investorenverhalten und natürlich auch Ineffizienzen an den Kapitalmärkten. Er hat einen PhD an der Harvard University gemacht, einen Master in Cambridge und seinen Bachelor an der Brown University. Wer selbst Kinder hat, das wäre so der perfekte Lebenslauf, nicht? Also, den man sich manchmal wünscht. Und darüber hinaus hatte er auch sportliche Erfolge. Er war 1992 Mitglied des US-Ruderteams und hat damals den 4. Platz erzielt. Vortrag ist Where to Take Risk, the Pricing of Interest Rate Risk in the Stock Market. Also wir werden ein bisschen davon erfahren, wie Aktien im Prinzip als Hedge funktionieren. Und ich freue mich, Herr Professor Baker, auf Ihren Vortrag. Wo ist er? Da.
Thank you very much for that kind introduction, or what I assume was a kind introduction. I'm not 100% sure. I heard something about rowing in there, and I will have to say that were it not for the Germans, I would have gotten a medal in the 1992 Olympics, so I'm a little bit upset about that still. No, it's a great pleasure to be here. Thank you very much for having me, and I'm delighted to have the opportunity to talk to you a little bit about where to take risk. And when you hear the question, where should you take risk in the capital markets, you might naturally think about strategic asset allocation. You know, how much on average should I have in stocks and bonds and other asset classes? Or you might think about tactical asset allocation. Where should I invest right now under current market conditions? In stocks or bonds, in emerging or developed, in corporate credit or sovereign debt. What I'm focused on in this presentation, I've been a bit preoccupied with a different sort of question about where to take risk. And the idea is that the capital markets often offer up exposures to the same underlying risks, but in different places. So I'll use the interest rate example because that's what I'm focused on today, but you could think of other situations where this is the case. You could increase your exposure to a level shift in US interest rates in a number of different ways. You know, so one, the most straightforward option would be to buy a long-term bond. Alternatively, you could think about an equivalent amount of risk by buying an intermediate-term bond with a little bit of leverage. That would sort of lever up your exposure to long-term rates. And then maybe a little bit more subtly, you could think about, you know, does your stock portfolio already contain exposure to interest rates through, you know, these more bond-like stocks? And given that there are these different ways of taking risk, which ones should you do, or which risks should you choose to hedge, and how? So in an efficient and integrated capital market, the answer is relatively simple if these really are the same risks, and admittedly, you're going to be picking up some other risks in the context of doing this in different ways. But if these are the same risks, then wherever you take them, the return should be the same. That sort of market efficiency says same risk, same return. But in inefficient and segmented markets, you know, this need not be the case. The same risk could get priced differently depending on who is the price setter in the different market and what that price setter thinks in terms of risk and return. So my aim is to answer, you know, or to offer some tentative answers to the question of where to take risk using the historical return data as a guide. So get my clicker here so I can make the technology work. So this is the plan, is that first I'm going to briefly describe the US-centric, apologies for the US-centric nature of the data in this presentation. I don't mean for it to be specifically applicable to US capital markets, but it was quite simple for me to do some analysis with US bond returns as well as the cross-section of stocks. So I'll first define what do I mean by interest rate risks. Interest rates, I think, have been particularly salient in the past 12 months. Just the move in the 10-year Treasury note went from a multi-decade low just 12 months ago, last summer, of less than 1.5% up to 2.5% in the so-called reflation trade before retreating a bit this spring. So just describe what I mean by risk in that context. Next, I'll describe how this risk gets transmitted into the US stock market as a whole. And I think we'll see in the last 50 years two relatively distinct regimes. We think about equities and bonds as a group, what their correlations have been. They've been both positively correlated in the earlier period and negatively correlated of late. And I'll describe, I think, in the next step, maybe more subtly, how this risk gets transmitted to individual stocks, some of which I would characterize as more bond-like, and some of which are less so. And to that point, this is a description of risk, not average returns. And of course, we can't know with certainty the future returns, but we can consider how the exposure to interest rate risk has been compensated historically in asset allocation. And by that I mean, what is the return to taking a longer duration directly in your bond portfolio, and alternatively in stock selection, where I mean tilting your stock portfolio towards greater bond-like exposure to bond-like stocks. So if this same underlying risk is priced differently, then it raises the possibility that markets are segmented or inefficient. And it would beg the question, why has this market pricing been in this way? Why has it been inconsistent? And that'll give me a chance to just do a little bit of amateur psychology, as well as think about some of the market imperfections associated with these trades. So what could cause bond-like stocks, on average, to be undervalued or neglected in the stock market? All right, so that's the plan. That last piece is, the underpinnings. I'll use the framework of behavioral finance, which is really a combination of psychology and institutional frictions. All right. So I hope that this is moderately legible. I realize my font choice might have been a little bit small here, but I can just see it down here on the monitor. All right, so I am going to begin with the measurement of interest rate risk over time, just to get a flavor of what we're talking about. And here, I am computing the volatility of interest rates from 1968 through the present in this chart. More precisely, I'm taking a moving average of the standard deviation of 5-day returns on US 10-year Treasury notes. So let me see if I can make this work here. So along this axis, I don't know if that's appearing. Is that appearing? Along this axis over here, we've got bond volatility. It ranges from 0.5% to 2%. Thinking of that in annualized terms, these are 5-day returns, so that converts to something like bonds have had as low as around 3.5% annualized volatility all the way up to a greater than 14%. So you can kind of see that through most of the history here, variability in terms of interest rate risk. So between 1968 and the fall of 2015, I'm taking a slow-moving average of around 18 months. And then to show the variation in this most recent period, taking a little bit of a shorter moving average of around 40 days, so that you can see some of the variation of late. And you can see the imprint of economic events over time, of market crashes, of inflation and deflation, and certainly recent politics in here, how those were related to the volatility of interest rates. You can also overlay on this recessions. I think that's pretty light on the screen there, but there's some light gray bars here that indicate when the US was in recession. Recessions are often the impetus to lower rates, creating some volatility, most recently with Lehman and the financial crisis, and sometimes raising rates in the early period with Volcker. That can cause a recession, so we have a little bit of cause and effect going on here. You can also look at Fed cycles. The green bars here indicate periods of loosening monetary policy when rates were generally falling. The most recent one in this 2009 period, 2008, 2009 with Lehman and the financial crisis. The red bars here are where the Fed funds rate was rising, tightening monetary policy over this period, including the most recent 18 months here. We've been in a period of continuous Fed tightening. Earlier on, you can kind of see a continuous pattern of rising, oops, went too far, a pattern of continuous rising and falling rates, and more recently it follows this pattern of rates rising or falling and then being held steady for a period of time. You know, most recently that's at a zero lower bound where we could think of this isn't going to fully capture monetary policy, as there's unconventional methods that are done once we hit zero interest rates in the US. So that's just a sense of what I mean by interest rate risk. It's the volatility of the 10-year Treasury note in this context. Of course, we could think along the lines of different bonds and global rates and so on, but that's what I've got for this talk. So interest rate risk isn't confined to the bond market. It's going to appear in the stock market as well. So what I'm doing here is the exact same thing, only now I'm looking not at the volatility of the bond returns, but rather their correlation with the US stock market, and at a somewhat lower frequency than before. So this is what the correlations look like through the fall of 2015, a 3-year moving average here, and then a little bit to show some of the variation of late in terms of how correlations have moved around over time. And you can think of this as both cause and effect. Sometimes it's the case that what we have is that stocks might be driving interest rate policy. So interest rates responded to the crash of '87, to LTCM, to Lehman. And meanwhile, the stock market might fall early on with the rise in real rates in the early 1980s. So there's not really thinking about this as interest rate risk is the most fundamental shock. There's maybe some omitted variable of economic conditions driving both. But what you can see from this pattern is there's two relatively distinct regimes, you know, in this first part of the history, overlaying these historical episodes here. We think of the first part of the history as being relatively positive correlation. The stocks were not a hedge for interest rate movements. When bonds were moving around, stocks were moving in the same direction on average with a correlation of about 0.3. And since that period, there's been a correlation of roughly minus 0.3. I mean, I could have started it in one period or the other because this is a moving average. Probably the LTCM, in my sense, is the moment at which correlations at least started to move in the direction of from positive to negative. So in the past 2 decades, early on, we've got them moving together. In the past 2 decades, they've followed a more familiar kind of risk-on, risk-off pattern. And in these recent correlations, you can see that rising interest rates have been contemporaneously good for stocks and bad for bonds. That's something familiar to you in capital markets these days. But, of course, things were relatively different early on in the history. So there's a standard sort of economic argument for these two different regimes. On the one hand, an inward shift in the supply curve means rising prices are coming from a contraction in supply, and that suggests tighter monetary policy might occur at a time of low profits and growth. We'd have a situation where that was bad for both bonds and stocks. The alternative is an outward shift in demand. That means rising prices and tighter monetary policy again, but in this case it means rising profits and growth. What's bad for bonds is good for stocks. Couple pictures here to just give you a flavor of what was going on during those two periods. Perhaps Paul Volcker is the poster child for the first era and Greenspan for the second. And with Greenspan in mind, a related interpretation of what's going on here with the negative correlation is that when markets fell, Greenspan and later Bernanke stepped in fairly aggressively in anticipation of an inward shift in demand and economic activity. In that sense, the Fed has become more attentive to asset prices. And then you could think of that as more of a direct effect where it induces a negative correlation between stocks and bonds. So just a recap so far. The most recent year has been marked by a slight uptick in interest rate risk with the reflation trade and its reversal. And the associated consequences of an episode like this with rising rates in the pre-1998 period would have been a falling stock market. Stocks and bonds have tended to move together in the early part of the history, because in those years the correlation was around plus 0.3. The associated consequence, though, of rising rates today, as well as in the most recent 2 decades, is going to be a rising stock market with a correlation averaging more like minus 0.3. So to the earlier question, which I think I understood in German, equity and bonds have become better hedges for one another through time. So in particular, it's worth noting that this recent pattern means that US Treasury bonds have been providing a significantly greater degree of valuable portfolio insurance than they once did. So mixing stocks and bonds together, I'm talking about kind of these bullets down here. When you mix a stock and bond portfolio together, the reduction in the risk from a pure stock portfolio is around 37% in the first half of the history. In the more recent period, the reduction is more like 50%. And that's in part, long-term bonds have been slightly less volatile, but the bigger effect is that the correlation between the two has turned negative. And in some sense, if this correlation were to persist, it might justify, at some level, the valuation that's inherent in historically low Treasury yields. They provide more insurance than they once did, making them more valuable if we think of equity risk as the most fundamental risk that investors face. Okay, so we've thus far considered the measurement of interest rate risk and the correlation between bonds and stocks in aggregate. So the next question is, what about the correlation between bonds and individual stocks? So you can think about the risk of an individual stock along the lines like this. This is what, very roughly speaking, an industrial risk model like Barra or Axioma might look at the risk of an individual stock as some combination of exposures to common risk factors, things like the market, to interest rates, to country, industry, and style factors, as well as a residual or idiosyncratic component. So I'm going to focus on these first 2 related exposures of stocks and interest rates. Stock market risk comes from a stock-specific exposure to the market over here. And that's going to be multiplied by the overall risk of the aggregate market. The combination of those two is the contribution of the market risk to an individual stock's risk. And then interest rate risk comes from a stock-specific exposure to the 10-year Treasury note, or its bond beta. So we've got stock betas and bond betas in here. And this gets multiplied by some notion of aggregate bond risk that we've been discussing so far. So this is really where the transmission of interest rate risk comes in, is through this combination of, what is interest rate risk and then what is the exposure. Yeah, so these are the white is sort of indicating what the betas to stocks and betas to bonds, and then this is the shock or the risk that comes into play. So the question here is, we know that we can find stocks that are predictably different in terms of their stock beta. These estimates are used to create the smart beta managed volatility portfolios that you're familiar with. And a first question that we have here is, can we do something similar? Can we do some kind of smart beta approach with interest rates? Whether the beta is smart or dumb, we'll find out. But can we find stocks that are predictably different in terms of their exposure to bonds? So what I've got here is a schematic that indicates that in each month going back to 1968, I'm going to kind of run a back test. So we've got 1,000 stocks that are kind of illustrated here with this grid. Put a couple of labels of maybe specific names that are in here. And for each stock at each point in time, we're going to estimate what the exposure of that stock is to the stock market as well as the bond market. So we've got two betas here, one to the stock market, one to the bond market. And we're interested at this point in, what is the bond beta of each of these stocks. And so schematically here, we can think of some of them as being low, some of them medium, some of them high, in the light, medium, and dark red. And if we want to run a back test to see how successful can we be in terms of finding interest rate sensitive portfolios, we want to take this set of 1,000 stocks in each month, and kind of sort it into buckets. Let's say hypothetically that McDonald's has a relatively high exposure to interest rates, GE medium, and Charles Schwab low. We're going to get portfolios that are cut up into these three groups. And then what we want to see is how well do we do? It's certainly possible that bond exposure is relatively unpredictable, in which case, in terms of the realized portfolio risk, we won't see a whole lot of variation as we roll forward. Okay, so what I've done is done that back test, and now I'm looking at the stock selection risk of these three portfolios of high bond risk, medium, and low to see whether or not we find predictable variation. So first, just focus over here on the right at these three bars. And what I'm showing over here is, these are the betas that I've estimated of this portfolio. So what we find is that the high bond exposure portfolio is successful in the sense that it has a beta of around 0.3 to interest rates. So what does that mean? It means that this group of 1/3 of the stocks that I've identified as relatively exposed to bonds, if bonds go up by 1% or down by 1%, on average, the move in this portfolio is going to be in the same direction to the tune of about 30 basis points. And the low bond exposure stocks is kind of the flip side down here, as they have a negative exposure, the opposite. When bonds move by 1%, we're going to see a 30% move in the opposite direction for these low bond exposure stocks. So we've been successful in finding a spread in stock selection of around 0.6, something between the highest bond exposure and the lowest bond exposure stocks. That worked as planned. This part over here was not entirely planned in the sense that these bond-like stocks, I've also computed what are their unintended exposures. We weren't trying up front to try to find low stock market risk stocks, but it just so happens that when you find stocks that are exposed to the bond market, these are lower than average beta stocks in terms of the stock market beta. This dark blue bar here, the corresponding exposure to stock market risk, is about 0.8, and this is around 1.3. So we get a similar magnitude spread in terms of exposure to the stock market. So we've got these two overlapping phenomenon. Bond-like stocks are both positively exposed to the bond market, and they're underexposed. They're still positively exposed to the stock market by less than those stocks that have medium or low exposure to bonds. All right. So this has, I think, some interesting implications for interest rate risk. Let's see here. In particular, we're going to have a direct and an indirect effect on the high bond beta portfolio. So when bonds fall in value by 1%, high bond beta stocks, so imagine that bonds fall. This is going to be relatively bad for bond-like stocks. Let's say they fall by 1%, bond-like stocks fall by 30 basis points. That would be a direct effect. But in addition, there's an indirect effect. And if we think about these in these two different regimes, early on, remember we had a positive correlation between stocks and bonds. So when bonds go down on overall, the stock market is also going down. For bond-like stocks, which have a low beta, there's sort of an insulating effect here. The stock market goes down, but at least on a relative basis, this is relatively good for bond-like stocks. So in this early era of the stock market, these two effects were kind of hedges. We could imagine good and bad news for the bond market. Sorry, toggling back and forth here. Good and bad news as being a hedge. The direct and the indirect effects kind of offset each other. In the more recent period, even though in some sense when I showed you that chart, the more recent period is a bit less volatile period which contains the Volcker rapid rise in interest rates that occurred in the late 70s and early 80s. What we have here with bond-like stocks is that the direct effect here is going to be relatively bad for bond-like stocks. But in this Greenspan era, where stocks and bonds move in opposite directions, that's going to be good for the stock market overall. And these bond-like stocks are underexposed to that positive market move, so that will also be relatively bad for bond-like stocks. And in some sense, these two are going to be amplifiers. The direct and the indirect effects work together. And we're going to have greater sensitivity when we have these stocks that look bond-like in the cross-section of stocks. And I think this is one reason why, when we think about stock market portfolios today, interest rate risk is maybe more salient. And I just want to show you this same thing in one other way, maybe in a simpler way, is I'm just going to show you here a plot a plot here in the first regime up through 1998. On this axis, I've got the return on the 10-year Treasury note. On this axis, I have the stock selection return, meaning the return on bond-like stocks minus the return on maybe not bond-like stocks. So this is a long-short portfolio over here. And what you see in the first half of the sample is that for every 1% move in bond returns, there's about a 28 basis point effect. So that 0.6 spread in beta that I showed you is attenuated by the market effects. And so we don't see quite as much of an imprint of interest rate risks on our stock selection during that period. In the more recent period, same thing, bond return on the stock selection return, the effect is more like 0.8, so 80 basis points in terms of the spread and return on this long-short portfolio of bond exposures. So much more interest rate sensitivity in the cross-section of stocks during this period because we have the amplification of these two effects with bond-like stocks. They're doing well or poorly both because of their direct exposure to interest rates as well as because of their relatively low beta. And that, in some sense, is an important narrative in the recent Trump or reflation trade. A lot of that, even what we see in the cross-section of stocks, can be thought of as an interest rates-driven trade. And here is, the one data point around the November election where we saw, bonds falling and bond-like stocks falling particularly strongly, maybe even more than the trend line historically. All right. So let me just give another recap so far. Recall that we started with interest rate risk, and then we considered the relationship between bonds and stocks in the aggregate, and now we've also looked at individual stocks. The important takeaway now is that we were successful at finding these predictably bond-like and not bond-like stocks. I need a better word than not bond-like, but if you have one, let me know. In the period from 1968 through the present, interest rate risk in stock selection of late has been elevated. It's been elevated in recent years because of the direct and indirect effects that have been amplifying one another. We're up from this 28 basis point number to 79 basis points in the recent period. So next question is, what do we do about this? Should we hedge this risk if we find it in our stock portfolio? And in some sense, I'm a bit abstracting from your view on interest rates. You might think interest rates are going to rise or fall, but this is a bit more of a risk question of, like, on average, how would I have done hedging this risk in a couple of different ways? All right, so where are we here? So there are two ways to go in terms of hedging this risk. I can do it through shifts in what I'm going to call asset allocation, meaning broad categories of cash versus bonds versus stocks. And the other is in my selection of securities. In particular, I'm going to focus on the selection of individual equities. You can take interest rate risk by increasing the bond beta of your equity portfolio. You could hedge it by reducing your bond beta. That would be the selection approach. You can take interest rate risk by increasing the duration of your bond portfolio. That's the most intuitive thing to do. You can reduce it, or you can hedge it by reducing duration. So the same thing applies. I've written both long-term bonds as well as the stock market. The same thing applies in the context of stocks. You can take stock market risk by increasing your allocation to equities as an asset class, or alternatively, you could increase the market risk in your portfolio by tilting towards high market beta stocks in your equity portfolio. And if the question then is, which of these two ought we to do? Oops, go back there. Which of these two should we do between the two? And I'm going to take a simple approach to that, is just say, where have these risks been compensated the most? And obviously, that's going to be a historical statement. So I don't know what will happen in the next 50 years with any certainty, but we can look at the answer in the past. And then we have to ask the question, is that a fluke, or is there some reason to think that the compensation might be persistently different? So something about the structure of the market that leads bond-like stocks to be valued differently, or their interest rate exposure to be valued differently than the same exposure is in the bond market. So what do we want to do then is we want to compute kind of what are the asset allocation returns, and we're going to do that both for stocks and for bonds, and then what are the selection returns. So the asset allocation part is easy to compute. Stock returns have exceeded Treasury bills by 5.9% per year. I'm showing that on the left in blue. And the 10-year Treasury note its returns have exceeded Treasury bills by 2.3%, which I'm showing in red. Over the full history, these two asset allocation returns are on average very slightly positively correlated. I showed you kind of there's a positive and a negative regime, on average slightly positive. So the orthogonal risk premia, which is just the dark part of those larger bars, is a bit lower at 5.4% and 2.0%, indicating that there's a small common component across these two risk premia. But these you could think of as the central risk premia. Obviously, there's other asset classes, commodities, and so on. But the central risk premia that we think about in capital markets, the stock market risk premium, think about it globally, as well as the term premium, or the return to holding longer-term fixed income securities. We could add to that credit and a few other things, but these are the biggies. So what about the historical stock selection returns to bond and stock market risk? That's going to be a little bit more complicated. In an ideal world, what I want to be able to do is find a portfolio that really just tracks the stock market as much as possible, but using only stock selection to do so. I obviously am only going to be able to do that on average, and there's going to be a lot of extra noise, and we can think about that as a driver of some of these differences. But it's basically the same approach of sorting the cross-section of stocks according to their exposure, either to the stock market or bonds, dividing them up into this high, medium, and low. For blue, I'm doing stock market exposure, then we'll do bond market exposure. We're starting with the equity market exposure. That'll give us kind of the familiar risk anomaly in equity markets that you might already know. But we look at what's the average return to a unit exposure to the market. And that means it just has a beta of 1.0. It means that in principle, putting 1% of your portfolio into this long-short portfolio should provide the same increase in stock market risk as moving 1% of your portfolio from Treasury bills into the stock market as a whole. If the market goes up by 10%, both of these methods is going to kind of increase your returns by 1% times that 10%, again, on average. So what's the return of that in the stock market in terms of stock selection? Well, that's actually been a negative number from 1968 to the present, minus 3.1%. So that's the pure stock selection portfolio. And this compares to the equivalent asset allocation return, because we've designed this, again, with a little bit of leverage to give us exactly an exposure of 1 to the stock market. We would have expected from our asset allocation evidence that this would have delivered a return of 5.9%. So a pretty dramatic difference between the returns that we get from taking market risk in the cross-section of stocks versus what we have gotten in asset allocation terms. There's one thing, since we're looking at bonds, This is a common theme in these kind of risk-managed portfolios, is they are exposed to bonds, at least unintentionally. This same portfolio has an interest rate exposure of minus 0.56. So this actually in part explains some of the gap, meaning that bonds on average had a positive return over this period. These high beta stocks were a hedge, or they had a negative correlation with that, and so that explains a piece of this minus 3.1%. Reduces it to something like only minus 2% once we've taken that into account. But the difference between these two is pretty large. Selection minus allocation is minus 8%. And that means that if you thought about this kind of history as repeating, the implications would be relatively clear. The upshot is that taking market risk through asset allocation has been richly rewarded, while taking stock market risk through stock selection has not been. So you'd want to lower your market beta through stock selection. That's kind of a smart beta approach with respect to this particular market beta. And you'd want to increase it through asset allocation, and at the same time hedge the interest rate risk with your bond portfolio. And that would be a better way of taking risk through this allocation approach, and then really offsetting that, doing much less and reversing the selection. Okay, so what happens when we do the same thing with bonds? So now I'm showing you the same set of portfolios that I showed before, the red indicating bond betas, sorting those into groups, and forming a long-short portfolio that has exactly a bond market exposure over this history of 1.0. So in principle, putting 1% of your portfolio into this long-short strategy would have provided the same increase in bond market risk as moving 1% of your portfolio from Treasury bills to 10-year Treasury notes. And this pure stock selection portfolio has an average return of plus 4%, meaning this unit exposure to bonds that in the bond market would have had a return of 2.3% had a somewhat higher return in terms of selection. And in this case, we have another unintended exposure to deal with. These bond-like stocks kind of automatically end up giving you a pretty big edge against stock market returns. They have an exposure here to the stock market of -1, as I told you, as large. Even though we didn't intend to find low beta, we found low beta through this bond-like stocks, and that has an exposure of 5.4%. And in some sense, this then deepens this gap between 4 and 2.3% because this provides a hedge of a relatively large return. And I've got, what is the return on the market after controlling for bond returns over this history of 5.4%. Taking all of that out, I've got the difference between selection and allocation in this context is quite positive. So the upshot is that taking bond market risk through stock selection has been relatively more rewarded. The asset allocation returns here have been positive, but not nearly as large. So again, were this to repeat, what would we want to do? We'd want to raise the bond beta through stock selection, reduce it through asset allocation, and hedge the stock market risk. So let me just show this to you again. It's the exact same numbers, but in a couple of different ways, using the bar chart, using some tabulations, and in particular to see how this unfolds over time. These are nice averages, but there are a number of risks that you face along the way in the sense that even though on average these have an exposure of 1.0 to either the market or to bonds, there's a lot of variability in the month-to-month returns. So these are the simple asset allocation returns that we started with, the 5.9 and 2.3. You can juxtapose these with the hatched stock selection returns. And these are essentially the returns that are achieved through stock selection, while in this case eliminating an unintended risk to bonds, and in this case eliminating an unintended risk to stocks. And this gap here between asset allocation and stock selection says that asset allocation has been richly rewarded in terms of stock market beta, and in this case over here, it's stock selection that has had a higher return than asset allocation. This is the same thing in tabular form. We can say statistically speaking, this market beta effect is statistically significant over this history from 1968, so for the last 50 years. The bond beta is much less significant with a t-statistic of only 2.1, and you can kind of see the variability decade to decade over time. There are all positive, but pretty variable. And we can see the volatility even a little bit more clearly in cumulative returns. So now I'm just taking those long-short portfolios and comparing them over time to the stock market or to the bond market. So this would be the return in terms of the stock market. So this is stocks minus treasury bills, in some sense close to a real return on stocks, going from $1 to around $10. If I get the same unit exposure to the market through stock selection by buying high beta stocks, shorting low beta stock, oh, sorry, yes, that's right. Buying high beta stocks, shorting low beta stocks will give me this unit exposure. Through stock selection, that has cumulatively destroyed a fair amount of our capital, going from $1 down to 14 cents. That's the minus 3% return that I showed you. For bonds, what does it look like? This is the very smooth return on a comparative basis of the 10-year Treasury note. And then this is our noisy attempt to try to find something that has unit bond exposure in the stock market. It has this higher average return that I showed you, but with a lot of volatility along the way. Most notably, in this period here, buying bond-like stocks faced a very large drawdown. Again, this is the version where we buy bond-like stocks and we hedge out the market exposure. And that's because in that period, bond-like stocks dramatically underperformed a very rising market. So you can think about these as certainly if you were to do a pure strategy like this is a lot of risk that you wouldn't necessarily want to face. In terms of risks for a diversified investor, probably low returns in a period of very rapidly rising asset markets in general is probably harder to say, this is an explanation or an unknown risk factor that should generate a high return. Okay, so I think I will just skip this particular recap, but basically here we've been focused on, in these two different ways of taking what seem like the same risk, or at least on average the same risk, what have the returns been? We found that in one case, the stock market risk has been compensated more in asset allocation than stock selection, and the reverse for interest rate risk. So I'm going to jump ahead and think about, why might this be the case? So in an efficient and integrated market, the return to the same risk, should have the same, should be the same. So same risk, same return. And so if we want to think about whether or not this is going to repeat, we have to have some explanation for, what are the behavioral or institutional frictions that would lead to this being a persistent effect in markets. So I like to use the framework of behavioral finance, which says that markets are inefficient and segmented. They lead to mispricing through a combination of behavioral demand, meaning demand that's less than fully rational. We can appeal to psychology there. And then some sense in which we can understand why professional investors who might observe these return patterns wouldn't lean against this behavioral demand more aggressively. And so let me give you an example. This part is a little bit lighter than computing bond volatilities. As much as I love the bond volatilities, I find them exciting. We can talk a little bit about representativeness and psychology, thinking about what would lead to some of these patterns in demand, or in particular a neglect of bond-like stocks. And then this is more, what is it about the contract with professional investors that might lead them not to lean too heavily against this phenomenon? All right, so the representativeness heuristic in my mind is about how we tend to make inferences using an association, sort of a casual association, rather than a strict method of Bayesian updating that takes full account of base rates. We think statistically in terms of all of the possibilities and drawing inferences from the data in that way. So in particular, investors might relatively casually identify what they think of are going to be the best individual stock investments using an associative or association type thinking. So I like, there's a suggestive Barron's article along these lines, which appears every once in a while, with a title that looks somewhat like this, how to pick stocks for the next decade, or in this case, this was 2014, was how to find 5-bagger stocks for the next decade. So I saw that title in 2014. Of course, I'd like to know the answer, so I read on. It turns out that the article lists the 10 best stocks over the last decade, which is, interesting stock market history, and, immediately raises the question in my mind, should I buy these stocks? Are those the ones that are going to deliver this return for me? They did it in the past, they can do it again. Maybe in the case of Amazon, that's true. But in many cases, the article seems to suggest, no, these have already risen and might even be prone to reversal. So, but what's the association that we might make at a slightly more sophisticated level, as we might think that we should find stocks that look now the way these stocks, over this history looked 10 years ago. So what did GMCR or Netflix look like in the mid-2000s, or Apple when it was really pre-dramatic recovery in the early 2000s? I think you would say that you want to find relatively small, high-risk, speculative stocks that are using new technologies, bringing those to bear in their markets. And here's where I think you can fall into a trap. Certainly if you bought these stocks at that time, you would have done very well. But the question is that's the association. This is a good investment. But in terms of a more strict statistical way of thinking, you'd say, what if I bought all of the stocks with those traits 10 years ago? Right? And there, a more careful analysis would say that if you bought all of them or one at random, you would have not done very well at all. You've done quite poorly in this particular class of small growth, high volatility stocks. And I think there's a tendency to neglect this base rate evidence and seek stocks that are the opposite of bond-like in the stock market. So as a stock market investor in particular, when you're looking for this kind of trade, you're going to avoid the ones that would have relatively high bond exposures. Here's a related example that's more recent that you're familiar with is Amazon. So Amazon, let's say, is the latest 10 and 20-year darling, really. It's risen more than 49,000% since its IPO. Up again this week with the Whole Foods merger. Can do no wrong. So the Wall Street Journal had a piece about this very recently, a very interesting article that had a bunch of nice nuggets and observations. But it makes one claim that I would disagree with. Right? So the first part is a fact, is that today there are many fewer small IPOs around than there were when Amazon went public. So that's kind of a fact. The IPO market is much smaller, at least in number, than it was in the late 1990s. So the author, though, what I would disagree with is laments that this is a great lost opportunity for individual investors because they don't have the ability to get this 49,000% return, right? So, we're depriving these investors of this wonderful opportunity here. And of course, if you had picked Amazon, you would have made a fortune. I wish that I'd put 10,000 in my own personal account. Unfortunately, I did not. But if you had bought the whole slate of IPOs in the late 90s when Amazon went public, I think we all know that or one at random rather than knowing which one was going to succeed, you would have destroyed a lot of your wealth. So I think, in fact, it's not a lament. In some sense, for the individual investor, we should be happy that they don't have the ability to do silly things with these very small and speculative stocks, right? Or at least that's what the history says. Now, I'm not saying that there are many reasons why I'd like to see a robust IPO market. I think it is in many ways the engine of innovation. But I don't know if it's the engine of individual investor wealth creation. In fact, it might be that it's the engine of innovation because you can get financing at relatively good terms as a speculative company doing something that might be socially useful but not a wonderful investment. So those are kind of my examples of why through association, and it's very easy to fall into this trap, you might end up neglecting bond-like stocks. So on the flip side here, we can think about professional investors, and so they're professional, so I need to put a few Greek symbols up there. Why they may or may not want to do this particular trade. One answer is simply that it's hardly a great long-short strategy that I just showed you with that drawdown and a couple in the 70s as well. But another is that a long-only portfolio in bond-like stocks is a good trade in a Sharpe ratio sense. In other words, it delivers a relatively good return here when compared to total risk. So the typical contract, though, or I think it's either implicit or explicit, that professional investors face is, I think, more of an information ratio, meaning I'd like you to deliver me a high return, and I want you to really minimize tracking error here. So I think this is obviously not the only contract that we see in terms of professional investors, but it still is probably the dominant one, is that either explicitly or implicitly we want to maximize the information ratio using a benchmark to keep track of performance. What this means is that bond-like stocks are going to do well at reducing this, but they are not going to do particularly well at reducing this. And so even if I ignore the long-short strategy that has a relatively poor Sharpe ratio on its own, even if I were just to buy these bond-like stocks, which would look pretty attractive along these metrics over here, not going to look as good here because they induce a fair amount of tracking error. They're going to take us away from the market, both in terms of their bond exposures as well as the implicit bet on stocks. All right, so these two, are sometimes the same, but not always. So let me just briefly conclude here. So I think interest rate risk is particularly salient these days in the context of recent events in the reflation trade. But moreover, in recent years, this risk appears more prominently in stock selection than it did in the past, in earlier eras when rates were rising, because the direct and indirect effects through an overall stock-bond correlation that's now negative, they're amplifying one another. So that when I see something like the taper tantrum or the Trump election, I'm seeing in the cross-section of stocks some larger impacts of having a relatively small interest rate exposure in my stock portfolio. And that risk, I obviously can let it run. If you were to think about, how should I hedge this interest rate risk, including options in your stock portfolio, the historical evidence would say maybe leave the stock portfolio as it is with some interest rate exposure. If you're worried about the overall interest rate exposure in your portfolio and you have the luxury of looking across stocks, bonds, and all of the different assets, you're not just an equity manager, then the option of hedging by reducing the duration of your bond portfolio might be appealing. Bond-like stocks, I don't have the evidence to say our bond-like stocks are more attractive investment right at this moment, but I would say the history says that on average, they've delivered a better return to that interest rate exposure than directly in the bond market. So thank you for your time and attention, and if there is time, I am happy to do my best to answer questions.
Thank you very much, Professor Baker. Thank you very much. Yes, haben Sie Fragen? Sie können die Fragen einmal über das iPad senden oder Ihren Arm heben. Dann werden meine Kolleginnen Ihnen das Mikrofon überreichen. Ich schaue gerade mal in die Runde. Hier vorne haben wir eine Frage.
One of the conclusions is that high bond beta stocks have a low volatility.
Yes.
Right. So we have seen over the past decade the rise of low vol equity portfolios in all different matters, because they outperform the stock market.
Yes.
Have you researched whether this low vol effect, is primarily driven by these stocks having higher bond betas, because we have, falling interest rates, positive bond market, which could explain why low volatility stocks really outperformed the broad market?
Yeah, that's a great question, and so these two effects are undoubtedly overlapping. Sorting according to bond beta gives you stock beta. Sorting according to stock beta gives you bond beta. I can answer one. I'll say the answer to a question which wasn't exactly what you asked, but at least I can answer it more confidently. Is that the low stock beta phenomenon is not fully explained by bond exposures. In other words, at least in the sense of bond exposures that we find in the bond market. So it could be that part of this is showing that bond exposures in the stock market have a higher return, so it has the potential to explain more. But I think usually when people make this line of argument, they're saying, isn't this just because of what's going on in the bond market? So the reason why it doesn't fully explain it is not because it doesn't go in the right direction, but because the magnitude isn't huge. In other words, that low bond beta, the low stock beta portfolio has a bond beta, of let's call it 0.2 or something like that. And so while that is going to chip away at what you would estimate to be the alpha or a cap M alpha of that portfolio, it's not going to, even with this strong bond return, isn't going to chip away at it enough to resurrect the relationship. So that's in that direction. In the other direction, which I was kind of interested in this context, is if I do a bond beta portfolio, am I doing anything more than rediscovering the low volatility anomaly? And to that answer, I would say a large part of what we're doing is rediscovering the low beta anomaly in a different way through bond beta sorts. So that I have less confidence that, certainly when we control for stock market and bond market returns, there is an alpha, let's call it, on this bond beta sort. If I also control for, say, the returns associated with a low beta strategy, which is going to be a particularly good asset, then that is going to eat away at most of the alpha of this bond beta portfolio. So I like to think of them as overlapping. And there's even an important question which has come up in the context of low volatility investing, which is, as you said, what should I do about interest rate risk? And I guess what this suggests to me is that if I have the luxury of changing my interest rate exposures in multiple different places, in other words, if I'm a full pension fund with assets in bond markets, stock markets, real estate, and so on, I might want to maintain my low volatility portfolio, recognize that it's exposing me to interest rate risk, which at least in the short run could lead to drawdowns associated with changes in monetary policy, let that run, and then over here in my bond portfolio, take that into account and dial back the duration of my bonds.
Thank you very much. There's another question over there, Riti.
I was wondering about the why behind this. So when you look at kind of all of those different portfolio sorts, is there a sector exposure that explains why certain companies or firms might have more bond risk exposure than others? Or is there has that changed over time? Just kind of that aspect of it.
Yeah, so two-part question in some ways. One is this an industry effect or is it a stocks within industry effect? And the answer, I think, I don't know specifically. I've looked at various versions of the sort. I don't think I've done it specifically with bond betas, but I've done it with stock betas and so on, is that there's a little bit of both. But it's definitely not the case that this is like utilities versus technology stocks, let's say. So you can do these same sorts. I didn't here. These are like the simplest possible sorts I could have done. But I could have said, let's look within industry, remove the industry component and just say stocks relative to one another within the industry. Why are they more or less bond-like? So that's fairly simple to answer. The why question, from the very high level, my why was more about why would people just neglect these bond-like stocks in general? Why specifically, what makes a stock have a more bond-like other than industry thing? I would say, that has to do with things like business model, operating leverage, and so on, which lead a company to be kind of to have more or less exposure to interest rates. But it's a good question, and one that I don't know the precise answer to. Is like, why is it that McDonald's has a high bond beta? I don't know for sure. Yes, follow up.
Can I ask a follow-up to that?
Yeah.
So I guess what I'm wondering about is when you said earlier that this is a lot like low defensive equity strategies.
Yes.
When you think about the holdings, are they very similar between those two strategies over time? And then related to that, in sort of low defensive equities, people say, well, it's market segmentation or leverage constraints, et cetera.
Yes.
Do you see that happening in these strategies as well?
I think that one is that they're overlapping enough that I abandoned the idea of finding just through stocks alone, finding this clean portfolio of, can I find these stocks that have a high bond beta and are neutral on stock beta? If you think about it in terms of, some diagonal, it's not that there's no off-diagonal elements there, but it gets you to a pretty small portfolio where there's then going to be a lot of residual noise in terms of the returns. It's just going to make it hard to detect anything. So instead, I'm just acknowledging that these are overlapping phenomena. They're not the same portfolio exactly, but they, I should compute, what's the active share between these two. The second part of your question was about defensive equity. Oh yes, to what extent? I mean, look, if I was giving a defensive equity talk, I would appeal to many of the same underlying behavioral and institutional drivers. I think tracking error is my favorite, but you can interpret that as a leverage constraint. In other words, why don't I tilt to low beta? The bond one is a little bit harder to do here through leverage, right? So the low market beta, if I have no leverage constraint, what I can do is I can say, well, I'm going to run a stock beta portfolio of 0.7. If I'm worried about tracking error, I can just lever that up to a beta of 1, and I can eliminate that piece. The fact that many institutional mandates don't allow that type of leverage to me, and they have this benchmarking component to me, is my favorite institutional explanation for defensive equity. In terms of the bond beta, it's a little bit different. If I can't lever that back up to get to neutral bond beta. And the same would apply in defensive equity. Once I levered that back up to 1, I would now have even more interest rate exposure that I would want to hedge in one way or the other. So, I think that I prefer, the kind of behavioral explanation that, these bond-like stocks with high bond, with low market beta, high bond beta are neglected for various reasons.
Okay, ich schaue nochmal in die Runde. Hier vorne noch eine Frage.
Yes, a lot of money has flown into low volatility equity,
yes.
And well, we've shown that these stocks have high sensitivity or higher sensitivity to interest rates.
Yeah.
What would you advise to people who have now invested in low vol stocks? How can they immunize their portfolio? Can they change something in the stock selection, or should they add bond futures, or do you have some other suggestion for these people?
Yeah, so I think there's two parts to that. One is with flows into defensive equity managed volatility portfolios, have the valuations of volatility stocks risen to the point that this historical pattern will not persist. I think the evidence there is a little bit mixed, but certainly tracking the various valuation measures of low-risk stocks, I think, is a useful way of keeping an eye on that. What is the overall market-to-book ratio, price-earnings ratio of that portfolio relative to the market? And it moves around over time, and it might suggest periods of time, maybe not necessarily that you want to move away from defensive equity, but you might want to run a slightly more complicated portfolio that tended to lean away from the stocks where the valuations had moved by the most. In terms of the interest rate risk, I think there's two ways to do this. And I think inevitably, as a manager of a managed volatility portfolio, there is a temptation to manage interest rate risk in the context of the stocks themselves. And that's something, that, in other words, try to reduce some of this reduction in bond beta within the stock portfolio so that at least with a sudden reversal in interest rates, you won't see as large a drawdown. Although I think this suggests that comes at a bit of a cost, and that if you were thinking more holistically, not as the investment manager, you might, or even as you were talking to clients who had these portfolios, to understand what those exposures were, and then maybe they could make changes in other parts of their portfolio rather than changing the stock selection, because these are so overlapping, you're going to be taking a little bit of muscle away, when you do the reduction in bond beta.
So thank you very much. Maybe
Yes.
one last question from the iPads, maybe a short answer. What could induce a regime change, reversal of negative correlation of stocks and bonds?
That's a question which, I'm not a macroeconomist by training, so some of these I was playing as if I was one, drawing aggregate supply and demand curves. You know, it felt good when I was doing it. But I think if we look back in history, this idea of, you know, will we get to an environment where it's more about supply shocks than demand shocks? So far, you know, it seems like we're relatively strongly in this regime where what's going on is there's an evaluation of what aggregate demand looks like, and I think that very much leads to this negative correlation. I don't see that changing in the near term. There's probably less likely to be the kind of supply shocks that drove that in the 70s and early 80s, just because of the diversification of inputs to various production. You know, we have globalized commodity production and so on in a way that, you know, we had much more concentration and the potential for supply shocks that existed. So again, take that with a large grain of salt, but that would be my sense, is that this current regime that we're in will continue for some period.
Professor Baker, thank you very much for the presentation.
Thank you. Thank you very much.
It was an honor to have you.
Thank you.